Hi, I'm Audie. Today, we aren't just looking at boring lines on a screen. We are going to decode the hidden market psychology that drives every price movement. Think of a price chart as a map of human emotions: fear, greed, and hope, visualized through the actions of millions of people. By the end of this video, you will be able to see the why behind the what when you look at a trading screen. To understand the market, you must first meet the two main characters in this story, the bull and the bear. The bull represents the buyers who push prices up, thriving on rallies and excitement. On the other side is the bear, representing the sellers who push prices down to capitalize on market drops. To survive this battlefield, you need three essential tools. Your entry point, which is where you join the trend after a breakout is confirmed. Your stop loss, SL, which acts as a safety net to close a trade if things go wrong. And your take profit, TP, which is your target level based on the size of the pattern you are trading. Every chart pattern fits into one of four psychological quadrants. We look at two main factors: which side is winning the x-axis and whether the current trend is continuing or reversing the y-axis. A continuation means the winning side is simply taking a quick resting break before pushing further. A reversal is much more dramatic. It means the current trend is dying out and the power is flipping to the other side. Understanding which quadrant you are in tells you exactly what the bull and the bear are thinking. Our first set of patterns are the flat line triangles. In a bearish descending triangle, buyers are trying to hold a floor line, but sellers are aggressively pushing the highs lower and lower until the buyers get exhausted and the floor breaks. In a bullish ascending triangle, the opposite happens. Sellers are defending a ceiling, but buyers are relentlessly pushing the lows higher, preparing to blast upward. For both, your profit target is usually the height of the triangle's opening. Next, we have flags, which are short pauses after a very sharp move. A bearish flag happens after a steep drop. Sellers take some profit, causing a mild bounce, but they are really just waiting to dump more assets. A bullish flag is a breather after a big rally where late buyers are eagerly watching to buy the dip before the price takes off again. In these patterns, the target is often equal to the height of the flagpole, or the sharp move that came right before the flag. Wedges are patterns where the price range starts to narrow, or squeeze. A bearish wedge makes higher highs, but you can see the upward energy is dying out and narrowing. A bullish wedge shows the price pulling back, but the selling pressure is drying up as the bear gets tired, resting before the next big push from the bull. Think of a wedge like a spring being compressed. Eventually, it has to pop in the direction of the opening. Symmetrical triangles represent a moment where the bull and the bear are perfectly evenly matched in a tug-of-war. Because neither side is clearly winning yet, traders look at the prior trend for a hint. If the market was trending down before the triangle, disappointed buyers will likely give up. If it was trending up, traders bet that the buyers will eventually win the struggle and continue upward. Now we move to the most exciting part of technical analysis, the reversals. Trends rarely die quietly. They usually put up a fight. Reversal patterns appear at the absolute top or bottom of a chart when a strong trend finally loses its power and the psychological battle flips entirely to the other side. This is where the big vibe shifts in the market happen. The head and shoulders pattern is the ultimate sign of psychological surrender. A bearish H&S shows the bull failing to beat a previous high, signaling that upward momentum is dead. A bullish inverted H&S shows the bear failing to push the price lower than before, spreading relief that the true bottom is finally in. Traders wait for the neckline to break before entering, using the distance from the head to the neckline to set their profit targets. Unlike continuation wedges, exhaustion wedges signal that the current trend has run out of gas. In a bearish rising wedge, the range squeezes so tight that the upward energy is completely exhausted, and sellers are ready to take over. In a bullish falling wedge, The downward trend slows as sellers simply run out of assets to dump and smart money begins to buy quietly. These wedges usually return the price to near where the entire wedge started. Double tops and double bottoms are easy to spot because they look like the letters M and W. A bearish double top M happens when the price fails twice to break a specific high, confirming a massive wall of resistance that panics buyers into selling. A bullish double bottom. W finds strong support twice, confirming a hard bottom and making traders confident that the worst is finally over. Triple tops and triple bottoms are even more powerful versions of the double patterns. When a price fails 3 times at resistance triple top, it strictly confirms that the trend has shifted to bearish. When a concrete bottom survives 3 separate tests, triple bottom, expectations for a massive upward rally become extremely high. These patterns represent a long, drawn-out battle where one side eventually completely gives up. To help you remember everything we've covered, here is your master cheat sheet. On one side, we have our continuations, like flags and triangles, which tell you to stay with the current winning side. On the other, we have our reversals, like head and shoulders and double tops, which warn you that a change is coming. Keeping this cheat sheet in your mind helps you stay objective during the heat of the market battle. Even with the best patterns, there is a golden rule chart. Patterns are probabilities, not promises. Market psychology can turn in an instant, creating what we call a fake out, where the price looks like it's breaking out, but then immediately reverses. This is why your stop loss, SL, is the single most important lesson for any trader. Your SL is your shield, and in the world of trading, the shield is non-negotiable. As we wrap up, remember that the psychological tug-of-war between bulls and bears is happening every single second. While they might try to hide their strategies, they cannot hide their emotions. Every candle and every pattern on a chart is a footprint left behind by the crowd. Now that you know how to read these footprints, you are no longer just guessing. You are decoding the market. Happy trading! Just remember, investing in options involve risk and aren't for everyone. So treat this as an educational guide for your financial journey. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.